The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our time to talk taxes. And you get the, by the time they let everybody else know the tax tips, like 3 weeks later, or the changes in the tax law, like that just happened a couple weeks ago, you knew last week, and they just publicized them this week. So I'm Esther Gulius, the Tax Lady from EG Tax. 803-0930, 803-0930, star 930 on a cell phone. Normally I do this the show with Tiffany and Christopher, but we take turns this time of year getting one or the other out of the office. So I have Tiffany with me today. Hey, Tiffany.
Hey there, Esther. I was looking at my calendar, and it's almost becoming March, and I'm very excited. I hate to wish time away, but occasionally during tax season, I find that I do that.
That's true.
Yeah.
Anyway, so let's tell everybody one of the, I don't know if you got it, but let me just say that you can't believe it, but I told you guys last week that Congress went and changed the tax law on this year's return, 2017's filing. They did it in the middle of tax season, and so it's retroactive. So if you know anybody that has, and there's really like 80 or 90 changes, but if you know anybody with these particular 4 items and they've already filed their return, they should amend their return because they have money coming back, and this change only just happened like 8 or 9 days ago, and it was just kind of publicized during the week last week, but right. I told everybody last Saturday. So the energy credits were not allowable for 2017 except for 2 weeks ago.
Right.
So now energy credits up to the $500 are still deductible. And so if you did insulation, if you put high efficiency furnaces in, if you put in high efficiency windows, Energy Star windows,
doors,
insulated doors, insulated garage doors, all of those are back in the tax law through this year, and you should amend your return if you missed it. Same thing for the tuition and fees deduction. So if you have kids that are, or yourself, that might be going to college and you've already used up the lifetime learning credit, then the tuition and fees deduction, which was not deductible until 10 days ago for this year, is back in, and so that's deductible.
Yeah.
And debt forgiveness on personal residences. If you've had a foreclosure, if you had your house taken back in a foreclosure, that debt forgiveness wasn't deductible. It is now deductible on personal residences. And here's another big one: PMI deductibility. If you are somebody that's paying a premium on your mortgage insurance, it wasn't deductible till 10 days ago. It is deductible now, so you can amend your tax return. So those are the 4 biggies.
And it's so cool. I was telling somebody we have these tools in our back pocket. So there was somebody that I was doing an AOT in lifetime learning. They had several kids, but really if I moved the lifetime learning to an adjustment, it yielded a better answer. So now we have that tool in our toolbox.
Right.
Yeah,
right.
Which is really good.
So if you know anybody that's already filed and they had those 4 situations, or they thought they were going to have to pay taxes on it, tell them they won't be able to get the credit for it unless they file an amended return, and that's Congress for you. So that's why you got to listen to Ask the Tax Lady. We will let you know. 803-0930, 803-0930, star 930 on a cell phone. So that's what you want to do. Make sure you amend anything that you want to tell people that are happening at the office.
We still have until the end of February where you can file your free 1040 EZs for the federal. So make sure you come in and get your 1040 EZ done for free, and just tax plan for tax reform for the increase in your paycheck you're seeing now.
And that's really, really good, because that's what every time I get done with the tax return, I say, this is the way it looks next year. Mm-hmm. How much are they giving you extra per month? $150. Oh, that's $1,800. Well, your real savings is only $200. So that means your refund's going to go down $1,600. Is that okay with you?
Right.
Not really.
Yep.
Well, then you need to contact your employer so that you can adjust that.
That's right.
Right?
That's exactly, because it's really, they change the tax tables, and so you should see more in your paycheck for most people. But if you have a lot of job expenses, you really want to watch out.
That's right. All right. And the other thing is, I know we got calls coming in, 8030930, 8030930, star 930 on a cell phone. We have all of our offices open 9 to 9 Monday through Friday, 9 to 5 on Saturday. The mall offices, we have 3 mall offices, McKinley Mall, the Niagara Fashion Outlet,
And Boulevard.
And Boulevard Mall. They're open during mall hours on Sunday. The rest of us are recuperating and worshiping and praying and needing the time off. So,
Yep.
Right?
Yep.
We do want to talk about, for those of you that have small businesses or rental property and you're wondering how the pass-through deduction affects you for next year, we want to talk about that after the break. And again, if you have if you have rental property and you're wondering how this is going to affect you, I can think of one of my clients that has, I think he has like 25 units.
Yep, I have one.
And
with
he
many
has a net
units.
profit of over $100,000. So he's going to end up with a $20,000 write-off next year.
Wow.
So this will be good news for him. And the other thing is, when you're doing your tax planning and you're looking for ways to cut your taxes, you may have never thought about rental property, and maybe now you will.
Yeah.
All right. Let's take a quick call before we take a break, and we're going to go to Jim in Cheektowaga. Hey, Jim, how can we help you, sir?
I had a question about estimating taxes for next year.
Yeah.
What was the standard deduction going to be for people 65 and older?
Well, it's going to be, and you're a married couple, right?
Oh, single.
All right, so that would be 12,000
plus 1,050, right?
right, plus 1,500. So it'll be 13,500.
13,500. And is there an easy way to figure how much of my Social Security would be taxable after I deduct the 25,000?
Okay, I can do it for you. How much Social Security do you get, Jim?
Roughly 7,500 or
7,500 for the year?
17,000.
Okay, so 17,000. And what other sources of income do you have?
Well, with income, I would estimate about 25, probably about 30,000.
And other forms of taxable income, right?
That would be our total. Yeah.
All right, so you have then half of your Social Security added to the other forms of your taxable income would mean that you have excess Social Security over that floor of $13,500 divided by 2. That's 12. So you have about $66,750 of your Social Security should be taxable, right around there.
Okay.
Okay?
Thank you very much.
You're welcome, sir. I'm Esther Goulias, the tax lady, 8030930, 8030930, star 930 on a cell phone. We want to explain how the pass-through works, and we want to talk to you about your tax questions, and we're going to take a short break. We'll be right back with your calls. Hey, it's not the end of the world yet. This is the tax lady, from EG Tax, Esther Goulias, and this is not the end of the world. This is the middle of tax season, really. And if you have any questions, 8030930, 8030930, star 930 yourself. I got Tiffany Fabian here in studio with us, and we got Jerry, who's been waiting a long time. Hey, Jerry, how can we help you, sir?
Hi, ladies. I just wanted to say Tiffany does my taxes,
Aw.
Hey, Jerry.
and she is super. And Esther, you got a gem right there.
I know.
I know. He used to work for the FedEx, I think, right, Jer?
Correct.
Yes. Good guy.
That's so nice of you to say that, Jerry. Thank you.
Makes my day.
She does a wonderful job.
On these
We're
long
very, very
days,
blessed.
I need to hear stuff like that
Yeah.
because it sort of propels you.
It
you
does.
know?
And just everybody, you know what? Go out there, go to EG Tax, whether it's Tiffany or anybody else, because they dig for you. They
Yeah.
stuff for you that you wouldn't think you could write off or deduct, and it's amazing. I mean, you guys are great.
Thank you, Jerry.
I always tell people it's sort of like a roofer. That's all they do. You become very efficient, and you know it when you do it all day
and you
long.
love people, too. Thanks for calling. Appreciate it. I'm Esther Goulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. And Kevin, how can we help you, sir?
Yes, good afternoon, ladies. Esther, a couple of months ago, you sound a bit disappointed when the Congress or the President announced the new tax. Tax.
Yeah, sure.
And you did say on your site you were going to put an app in which we can look at it and see how it will affect you in one way or the other.
I think that's on there, isn't it?
Well, the app,
it's on our website.
You can access the app, but do you mean that on the app about the tax changes?
So what happened within the last week or so? Has it changed?
Oh, okay. So
you
know what happened? Remember they were doing that budget reconciliation thing so they wouldn't shut down the government, Kevin?
Right, yeah.
Okay, so when they did that, they put in about 40 or 50 tax changes for 2017, not 2018. So 2018 right now is still in concrete, but then how concrete, we don't know, because you're dealing with people that I think are probably hearing pros and cons to how the 2018 tax laws are going to affect them.
Was that what you were asking, Kevin?
But there is on our website a place to go to. I think it's on our website where you can actually see how your
there's a spreadsheet.
There's a spreadsheet that you can see how the 2018 tax return will affect your tax return.
Oh, okay. So it was really 2018.
Yeah, because that's not 2017 is just the way it always was. 2018 is when the changes are taking place. So when we're doing a 17 return, we tell people, and this is how 18 will look.
Right. Okay.
Okay?
I see. Okay, well, thanks again.
All right, thanks for calling. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. Before we get to the calls, I want to talk about one of the changes for next year is for small businesses. So if you have a small business or rental property and it's making a profit, if you have a personal service business and your income's under $350,000, you're going to be able to take a deduction of 20% of the net profit. So you think about rental property. My guy who's making about $100,000 and some from his rental property, bottom line, he's going to have over a $20,000 deduction, which is going to equate to about a $4,000 tax cut for him. So these are things that you want to take a look at. Let's say you are a realtor and your net profit is $60,000. You're going to next year have a $12,000 below the line write-off. So this is after your standard deduction, and that person would save $2,640 in taxes. If you have a subchapter S with a net profit of $200,000, you'll receive a $40,000 write-off, which will save you $12,800 in taxes. So those are just examples of some of the things coming down the pike, and that's part of what we want to help you with. Is it's not just this year, which is really, really, really important, but you want to make sure that next year you're prepared too, because they're giving you extra take-home pay. I'm sure you've noticed. A lot of people say, "I was wondering what happened. Why am I getting extra money?" Well, they're giving you your refund in advance.
Right, stimulating the economy, putting more money in the economy.
But the thing is, if you really like a $3,000 refund and they're giving you $2,500 up front and you're not getting much of a tax cut, because many people aren't getting a tax cut, in essence, you're getting $2,500 of your $3,000 refund, and next year it'll only be $500.
Yeah.
So those are really important things.
And then going back to the pass-through, I think you told me best the reason that they did this pass-through credit for small business owners.
It's not a credit, it's a
deduction. And that's because they have they're lowering the corporate tax rate. So this was something that they were tossing to small business owners.
Right,
and so
because they're saying it isn't fair that you just are really giving a deduction to the C Corps. How about the rest of us?
Right.
And so there are lots of things that you need to tax plan.
Correct.
All right. Let's go back to the phones. We're going to talk to Sally. Hi, Sal.
Hi. The question I had dealt with New York State.
Yeah.
Tax on capital gains that I have from selling some mutual funds.
Okay. What's the question?
Well, how, looking at the federal, there will be no tax, but what about...
But New York State is not the federal, and they do tax you on the capital gains.
And how is that done?
Just regular tax liability. They don't give you any benefit on New York State for capital gains.
You mean you figure that in as part
Well, I'll give you an example. Let's say that your capital gains on page 1 of the 1040 is $10,000.
Okay.
But then you figure the tax liability on the Schedule D using an alternative method of tax computation. And if you're in the 15% bracket or lower, you'll pay zero taxes. That's your situation. But when you go over to New York State, the whole $10,000 comes over to that, and that just gets ratcheted into the total taxable income from New York State, and they apply the tax rate to the total amount.
Oh, I see. Oh, that's terrible.
I know.
Okay. Thank you so much.
You're very welcome, dear. Bye-bye. And maybe in her situation, she'll be able to use an IRA. A lot of times, if you got extra income and wages, using an IRA now, if she's over 65,
right.
over 59 and a half, she could put $6,500 over 50. I'm sorry, over 50, $6,500 into an IRA, and that might save her tushy because that would be 100% deductible.
As long as she has earned income. Yep.
Right. Earned income. Right. Let's go to Larry. Hi, Larry. How can we help you, sir?
Hi, Esther.
Hey, what can we help you with, sir?
Two things. One is a friend of mine, I believe they put a high-efficiency boiler in 2016 or 2017. Would that be deductible in 16?
If in the year they put it in and paid for it is the year it's deductible.
Okay, and then I have a question. I invest in monthly real estate dividend stocks. Now, there's something I saw where you get up to 23% as a tax write-off for the dividend only?
You mean if it's qualified dividends, you get a special treatment?
For the real estate investments only.
No, not at all. You're thinking it might be the capital gain. I really don't know what you're talking about specifically, Larry, but there is no special tax on real estate investments only. So there's nothing special. Now, maybe you're thinking in next year, the pass-through is going to be 20%. It's going to be a 20% deduction next year and REITs are going to qualify. So that might be what you might be looking at 2018 and mixing it up with this year.
I am. Yep.
Okay.
Thanks for all you do for us.
Thank you so much. Thanks for calling. Yeah, that's what's going to happen next year.
Right.
So next year he'll get the 20% pass-through, not 23%. And again, it's after your standard deduction. And there are no personal exemptions anymore, so, Okay, we'll go to Bobby. Hey, Mr. Bob. Robert, how can we help you, sir?
Yes, Esther.
Yeah.
I have some capital gains and capital losses. And I transferred the amount to Schedule D like instructed. And the net result is a gain of $437.
All right.
Where does that, after I have it in line 16, do I have to go to Part 3? And
yes.
What do I do there?
Okay, there it's going to, Bob, give me an idea what your other sources of income is. So you got Social Security, right?
Yes.
How much, and you got a pension?
Yes.
How much is your pension approximately?
The pension is only $675, but...
All right, wait, and then are you taking any out of your IRA?
Yes.
How much?
About $6,500.
All right, and so any other source of income, dividends?
Yes, there's about $5,000.
In dividends? Qualified or non-qualified?
It's just interest.
Oh, it's interest, not dividends, right?
Yeah, interest.
Okay. Any other source of income besides your Social Security?
No.
And then there's that Schedule D transaction, right? Are you single or married, sir?
Single. The Social Security is $10,800.
Okay, so let me tell you this. Without your gain from your stock, you said like $600, right?
$437.
All right, so your standard deduction is
it's about
65,
65
and you're over the age of 65, right?
Yes.
8-4. All right. Till you get to about $12,500, you're not going to pay any taxes anyway. So the Schedule D Part 3 is going to make sure that you're taxed at 0%. but I'd run through it if I were you, because it sounds like it's going to be a conundrum for you. Are you doing it by hand?
Yes.
Yeah, that's what makes it really hard. But I believe if you just add it in to your income without doing that Part 3, I think you're not going to pay taxes anyway. I could make you go through that Schedule D Part 3 to make it 0%, but I think you're going to be at 0% anyway. So, but if you do pay any taxes, the Part 3 portion will have you not pay taxes. So, but it can't be much that you're going to pay in taxes anyway.
Well, I figure about $80.
Okay, well, if you want to save $80, go to the Part 3.
Okay, one more question.
Yep.
On a consolidated 1099 form, they're under 1099 dividends and distribution. There's a payment of $237.
For what?
Pardon me?
For what?
For exempt dash interest.
All right, so that's not taxable. It's tax-exempt interest. It's a return of capital.
So that is entered where on the...
Nowhere.
Nowhere?
Nowhere.
Okay.
Okay?
Well, yeah. Okay, thanks.
All right, thanks, Bob. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. We're going to take a short break for the news, but we'll be back on the other side with your questions. Hey, we're hanging out with the family, and when you're part of EG Tax, you're part of our family. I'm Esther Gulius, the tax lady from EG Tax. We have 33 area offices that are open 9 to 9 Monday through Friday, 9 to 5 on Saturday. Our 3 mall offices are open on Sunday, the McKinley, the Fashion Outlet, and Boulevard. And we certainly want to help you. Just like we were talking about Bob when he was saying, he doesn't want to do that Part 3 and he's doing it by hand. It's like an exercise in gymnastics to save the money, but you do save the money. Now, he was only going to save $80, but there are people that are listening that have qualified long-term capital gains, and they don't use that form, and so you're taxed where you should be taxed at 0%, you might be taxed at 15%. Now, that's $1,500. To me, that's a lot of money. I don't know.
I pay enough is the way I look at it.
We're going to go back to the phone, so we're going to talk to Barb. Hey, Barb.
Hi, how you doing?
Good. What can we help you with, dear?
Let me ask you this. I'm on disability and have been for a couple of years. And last year we had to start installing, all the railings in the house with an outside carpenter. Now, this year we had to put a small platform in the back off the back door with all the railings and everything. And I'm wondering, is that a home improvement under the tax laws, or can I take some of that off?
Okay. So Barb, this was to help you to alleviate a problem with your medical condition, correct?
Yes.
Okay. Whenever you do an adaptation, whether it be to your vehicle or your home, in order for you to live your life more fully, that is a medical deduction, but it has to be phased in based upon if it made your home worth more. Now, to most people, grip rails do not make your home worth more before that was done to after it was done. So what you need to do is maybe have a realtor come over and say, here's all the handicap access points in my house. Would you say that there's an increase in the fair market value of my house? If they say no and the grip rails cost you $8,000 and your platform and everything, then you have an $8,000 medical deduction.
Yeah, I figure the platform was $7,800, and then all the railings came up to about $400.
Yeah, so plus everything else you do. Barbara, if you need a special commode, if you need a walk-in shower, whatever you need in order to alleviate a medical problem is going to be a medical deduction. But obviously prescribed by your doctor.
I was wondering, since you're on disability, do you have to file? Do you have income? Do you have liability?
Yes, we do.
Okay.
We filed as a couple.
Yeah, right. So if it goes to eat up a debt and a bill, so that if you itemize, that's what it'll do. Yeah. And so Esther's, of course, right.
Yeah, and the thing is, I never took I have every equipment you can imagine here, but I never deducted it. That's the first time I'm thinking about it after we put so much money out.
Wow. How much have you put in your house per year on average, Barb?
Well, I've had 6 surgeries in 7 years, so over the years, I got all the equipment for the bathroom and the upstairs, downstairs, commodes, all that kind of stuff.
See, every year is taken on its own initiative. So in the past, it was like the 7.5% of your adjusted gross income. So you just can't take what was in the past and write it off. You really have to look at each year individually, and the statute ends every 3 years. So after 3 years, you can't amend the return to get your money back. But you might. Do you normally itemize, you and your husband?
Yes.
All right. So you might take a look at 14, 15, 16, because 14 is going to be closing April the 15th this year. Okay. So you could amend 14, 15, 16, and then, of course, this year, 17.
Okay. All right.
All right?
Yeah.
And don't forget your medical travel, your co-pays, your Medicare Part, if you're Medicare Part B, your health insurance, your mileage, ambulance, God forbid, hospital, all of that stuff gets added once you can qualify for the medical.
Wow. Yeah, there's so many things that are involved in all of this. It's mind-blowing, and I dread the tax year because I don't know what I should do and what I shouldn't do, but I'll do the best I can, and I'm so grateful that you're on the radio.
Well, thank you very much. I hope you feel better.
Thank you.
Thank you, dear. Bye-bye. Okay, let's go to Jerry in Tonawanda. Hey, Jerry, how can we help you, sir?
It's me again. I have a question. The other guy made me think of something. I'm thinking of selling some of my oil rights for around $30,000. If I know that's got to be taxed, but can I put that some of that in an IRA to keep me from being taxed so much? Or
no. I mean, only. Are you still working, Jerry?
No, I'm retired.
Okay, so you have to have wages in order to put money into an IRA. But it all depends on what your total income is and what your gain's going to be. How much did you pay anything for the rights?
He inherited it, I think.
Oh,
right?
Okay, so he'd get a stepped-up basis. Mm-hmm. So how long ago did you inherit the oil rights?
About 10 years ago.
So back 10 years ago, you need to find out what those oil rights were worth. And then when you sell them, if you do, there's going to be a capital gain. Now, if you sell them for $30,000 and they were worth $20,000, then you only have a $10,000 gain. And you may, if you're in the 15% bracket or lower, you wouldn't pay possibly any taxes on the federal, but the state of New York would tap you.
But if they're not value, if I can't find the value of it, if it isn't stated,
then unfortunately you have to go down with a zero basis. But it's hard to believe that somebody that is in where is the oil wells at?
North Dakota.
So I got to believe somebody there is an expert. I'd look for an appraiser who would be able to. It'd be worth it because that would also be part of your cost basis, getting the property appraised. Mm-hmm. It's worth the time to do it so that you don't have to pay the taxes.
Okay.
Okay.
I wonder if you Google other people in North Dakota.
Yeah, get an appraiser. It's got to be an appraiser. Yeah. Okay, Jer?
Okay, thank you.
Thank you, sir. I'm Esther Gulius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. We'd love to hear what people have to say. All right, we got Ed. Hey, Ed, how can we help you, sir?
Yes, Esther. I'm looking at the state and local tax deduction worksheet for Schedule A.
Yep.
And line 7 of that worksheet, it says, enter your state and local general sales taxes paid on specific items, if any.
Right. Mm-hmm.
Look at the instructions for line 7, and it gives this example. It says, enter the state and local personal property taxes you paid, but only if the taxes were based on value alone and were imposed on...
Okay, if you paid personal property taxes, but you're not paying personal property taxes in New York, you can increase that state and local sales tax deduction by moving vehicles, such as a boat, an RV...
motorcycle.
And when you go to the chart figure, they're going to give you the 4% New York State figure. You have to increase that by another 4%, for instance, if you live in Genesee County, 4.75% if you live in Erie County, 4% if you live in Niagara County. So if the chart figure says, based upon your income, your deduction is $600, you would double it if you lived in Niagara County, which would be $12. And to that, you would also add the sales taxes paid on moving vehicles.
Right. Now, I understand all that. The example they give is this. So you paid a yearly fee for the registration of your car.
Based upon the value.
Right.
But that's not how
we
it's
don't
done.
live in an estate.
We don't have personal.
Based on the car's value.
Right. We don't have that.
How do you determine that?
We don't have it.
We don't have a personal property tax in New York State.
What you might want to do is call New York State and see if they have a hidden one, but we don't have one.
Right.
In other states, you have to go in and they determine the value of your car and they assess a tax every year, and that's called a personal property tax.
Okay.
Okay.
Yeah. Could I just one more on the
Sure.
Essential Energy Credit Form 5695?
Uh-huh.
The only things that they list as qualified are solar.
I know. I was telling you at the beginning of the show that they changed the law last week. And now it is deductible. What was the law in December, they changed last week.
So you're looking at
now
an old
you
form.
You're looking at the form that was valid in December. Now in February they changed the law for 2017. So what you might want to do is take a look at a 2016 energy credit, because that's where the
page 2.
That's where the correct figures would go.
Thank you very much.
You're welcome. And that's what's so confusing. People look at the form and say, it's not
right.
It can't be right, but it is right. Hey, I'm Esther Gulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone, and we have Mike from Cuba. Hi, Mike.
Hi, Esther. I want to ask a question.
Now, we should be speaking Spanish because you're from Cuba, see?
That's right. Esther, I make, I got a small pension and my Social Security.
Okay.
6. And I make $1,491 a month from Social Security and $563 a month from my pension.
Uh-huh.
And maybe $18 a year in interest. Do I got to file this year?
Not unless they took taxes out.
No, they don't take taxes out enough.
Then you don't have to file.
Okay.
But wait, let me just ask you one thing. You're not retired on a disability pension, are you, Mike?
I was up until I turned 66.
Okay. Because if you were 63 or 64 before normal retirement age, then you would file because that disability pension would be considered earned income, and you would have gotten an earned income credit. But now, being a more mature gentleman, you no longer qualify as someone who's retired on a disability, but it's converted to a regular pension, and you won't be able to use that for EIC purposes.
Where you used to be able to.
Now, last year, did you file, Mike?
I haven't filed in about 5-6 years.
Okay, but you should amend. Has this been the situation all these years?
Or is it a Social Security pension that you get?
The lady told me about 5 years ago I'd have to file no more. So
okay. You know what, Mike? There's a lot of things in the tax law you don't have to do. You just want to do it. If you were retired under age 65 on a disability pension, not Social Security.
Yeah, because
you got a pension,
he said
right,
Social
Mike?
Security, $14.97, pension $5.65.
Right, you got a pension, right, Mike?
Yeah, pension.
And okay, that if you were retired on a pension under age 65, you can amend your last 3. Actually, you can file the last 3 years' returns before you were 66, and they're going to give you a refund because you get an earned income credit.
Oh, okay. All right.
Okay?
I'll call you up Monday, Esther.
Thanks, Mike. Bye-bye. I don't know if he believes me or not. But anyway, because that's what's so interesting, that when you're retired on a disability pension, you can use that as wages. And because his income is lower and he's single, he'd get an earned income credit.
I was thinking that, and you said it.
All right. Let's go back to the phones. We'll go to Pat. Hey, Pat, how can we help you?
Hi. I have a question about money that can be put into an IRA. I was told last year that because I have a New York State pension, I'm still working, but I have a New York State pension, and I also invest at work in their tax-free program, and I invested probably $6,500 last year. And my question is, my accountant told me that I can't.
Because you make too much money and you're covered by a qualified plan, I'm pretty sure.
Right. Because what's so hard, Pat, is we can't talk about all of the phase-outs because we'd be here. First of all, everybody would be sleeping listening to us because there's all these phase-outs. If you're covered under a qualified plan at work and your income is over a certain threshold, then you don't qualify
for putting money into an IRA.
Into a traditional IRA. So you have to listen to your accountant; they would know.
So you can't put it in a Roth either.
The Roth thresholds are higher. I think it's like $135,000 for a Roth. I think you could put it in a Roth.
Are you single or married?
Single.
All right. The Roth threshold is 118 to 133.
And that's without. So then they don't consider, when you say qualified plan, is that like my pension? Or
yeah, when you have the X box chalk, when there's a little check mark in the pension part of your W-2, that means you're covered under a qualified plan. And if you are, and you're looking to put money into a traditional IRA and you're single, it phases out at $62,000 to $72,000. That's for a traditional IRA. On a Roth IRA, it phases out between $118,000 and $133,000.
Okay, but from my pension, although I invested, I will not make that much money.
All right, so you don't make $62,000?
Oh, I make about 62 or 60. The cost is maybe 65. But
okay, but all right, so it's phasing out between 62 and 72. So there's a 10%. If it's 60, how old are you?
I'm 67.
All right. So for your $6,500 traditional IRA, if you're over by $2,000, you're going to lose the deductibility of about $1,200. So you can still put $5,300 into a traditional IRA.
I can?
Yep.
Well, do you have other income?
Pat, I do not have a crystal ball, and I cannot see what you're seeing. But based upon what you just told me, you should be able to make a contribution to a traditional IRA.
But you're close, so we might be.
But she's in the phase-out.
Mm-hmm. Mm-hmm.
Did I tell you that I also put away 65?
No, you didn't mention. Where do you put it away at, Pat? Through your employer?
Deferred. Yeah, there's a tax deferred.
You mean 403B?
Something like that.
Yeah, well, the IRA would be over and above that. You could do that anyway.
Oh, okay, cool. Thank you so much.
All right, thank you, dear. Bye-bye. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone, yeah.
Hey, I wanted to say that I've been noticing a few clients haven't registered for the star because you had to go online, and so I'm looking at their property tax statements all the time. I was with somebody yesterday, and they were a young couple, and they weren't getting the star deduction, so don't forget you have to go online.
That's right. If you bought your house in the last year, they don't take the star deduction anymore off your school taxes automatically. You have to apply for it online or else you lose it.
Right.
I wonder why that would be. Do you think that they would know that people wouldn't do it?
I think so.
You think that's just like when they charge a bed tax for somebody that's in a nursing home and they know that the money would come back if you apply for it, but it's up to people to apply for it. And if you don't apply for it, they're not going to give you back your 6%. You think that has something to do with it?
Breaks my heart because they have 4 kids. It just breaks my heart.
Anyway, all right. We got like 5 minutes here. Things not to do. Don't take money out of your pension plan unless it's your last option.
Right.
So let's say you have credit card debt of $40,000 and you're losing your mind and you say, I just can't stand it. I think I'm going to take $40,000 out of my pension plan. And you're under the age of 50 years old. Let me tell you what happens. If you take $40,000 out of your 401k plan, okay, and you'll be in the 22% bracket, this is next year, you'd pay 22% taxes on the $40,000, plus a $4,000 penalty, plus New York State is going to get you. So you would lose almost $16,000 of your $40,000 if you take it out of your pension plan. Here's what you should do. Consider, if you got a home, borrow the equity out of your house, because borrowed money is tax-free. At 5% interest, it would take 8 years of interest for you to equal what you'd pay in taxes on that 1 year if you took the money out of the 401k.
That's right.
Secondly, or consider borrowing against your own plan using the 5-year payback, and you're paying yourself back the money. Again, it's tax-free. Thirdly, try to negotiate a settlement. Call the credit card companies and see if you can't negotiate a settlement. And if you are insolvent, you have more liability than you have assets, it's tax-free.
That's right. Do a Form 982 and it's forgiven.
Right. And finally, if it's so terrible, the last place, even New York State doesn't want you to take money out of your pension plan, consider a bankruptcy. Because really it's like dragging around a dead body. It ain't going to go away till you get rid of it, and taking money out of your pension plan is really not a smart thing to do. All right, let's go to the phones. We got Carol. Hi, Carol. How can we help you?
Hi. I have declared my long-term care insurance every year.
Yay.
Still able to do that?
Absolutely.
Thank you very much.
Thank you, sweetie. Bye-bye. Good question. Good question. All right.
Now, it's something to think about. If 2018, it'll be harder to itemize, but you can still take your long-term care as a New York credit,
right?
But it might not be
and
for
it'll be interesting to hear what New York is going to do, because they're talking about letting you itemize on New York if you can't itemize on the federal.
Right. That's interesting.
All right. So think about, if you're somebody that's thinking about doing tax planning for 18, remember, think about the business as an investment and the pass-through, because those pass-throughs can save you a lot of money. And a lot of you businesses that are out there, you need to think about this when you're doing your estimated payments, because you won't need to pay in as much if your business is making a net profit. Realtors are, who are so busy making all this money.
Right.
They're going to be perfect examples of people that are going to get these pass-through investments. So you want to make sure that you tax plan. And the other thing is, rental properties also going to qualify. So that's very, very important.
There's a lot of people, for instance, I have some people who have rentals who have losses, and you had a really good idea. They might want to get another property that's doing really good and start, might be
and the other thing is,
productive.
There are businesses for sale on bizbuysell.com that are in our area that are making money. You might want to take a look at buying a business that's throwing positive cash flow. It's a great thing to do. The other thing is, remember, even though you're getting extra money in your take-home pay, you want to make sure that you know how your taxes are going to work out next year, because they may be giving you take-home pay that you shouldn't be getting, because it's going to affect your refund or balance due next year. So it's real important that you, I think we have it on our website, don't we, Tiff?
We do. You can plan looking at 2017 and 18 to find out where you are and make sure that you're not going to be short. I think one of the most important things is, I always say to my clients, what do you want? Do you want to have a big refund? Is this okay with you? And so you have to find out.
But here's the other thing. With that extra money, do something constructive with it. If you find out that, yes, my gosh, I get this extra money, don't just go buy a flat screen TV. Put more money in your 401k. Pay down old bills, right?
Yep.
Do a 529 plan for your kids for college. That's deductible on New York State. Or make an investment. I mean, those are things that you should do. Hey, I'm Esther Gulius, the tax lady from EG Tax. Until next week, we're available. All of our offices are open 9 to 9, Monday through Friday, 9 to 5 on Saturday. We'd love to help you. When you're thinking about taxes, think of EG Tax and come join our family. God bless you. Bye-bye.